Hospitals are usually considered difficult businesses. They require huge capital investment, highly skilled doctors, expensive equipment, and operate in one of the most regulated industries. Most hospital chain competes by offering better infrastructure, premium room, and charging higher prices. But there is one company that chooses a completely different path. And that path was shaped by one man, Dr. Devi Shetty. He's a renowned cardiac surgeon who left a successful career in the UK and returned to India in the late 1980s with a belief that world-class healthcare should not be a privilege reserved only for rich. Instead of asking, how do we charge more? He asked a very different question. How do we reduce the cost of delivering world-class healthcare? That single question eventually became the foundation of Narayana Health. Today, Narayana Health operates nearly 6,000 beds across India, the Cayman Islands, and the UK. Despite charging significantly lower prices than many of its peers, the company has consistently improved its margins, generated strong cash flow, and created enormous wealth for shareholders over the last decade. So what exactly is different about Narayana Health? Is it simply lower pricing, better doctors, superior execution, or is there an entirely different operating philosophy hidden beneath the financial numbers? So in this video, we'll go far beyond the balance sheet to understand the problem Dr. Devi Shetty is trying to solve, the operating model of Narayana Health, the economics of business, and where does the next decade of growth come from. Finally, we'll look at the key risks to keep in mind. As usual, this is not a buy or sell recommendation. If you're here for that, you can skip this video. The idea behind this video is to understand the business of Narayana Health and whether it can be a wealth creator for investors or not. But at the end of the day, you should build your own conviction before investing your money. Otherwise, even a 10% correction would create panic. And if you are someone who does not know how to identify right companies and build a strong portfolio, you can explore my exclusive weekly video series where I track nearly 200 companies and share my own investment strategies with logical reasoning. Since we are in second quarter now, many companies have started sharing their Q1 updates and result season is about to begin. So it can be a good starting point. For more details, you can explore the join button of this channel or my website. Alright, let's get started. If you look at the most successful hospital companies today, they talk about clinical excellence, world-class infrastructure, advanced technology, renowned doctors, and premium patient experience. Narayana Health certainly possesses many of these qualities. But if you listen to Dr. Devi Shetty, you'll notice something interesting. He really starts by talking about hospitals. Instead, he starts by talking about a problem, and that problem is simple. Millions of people don't die because modern medicine cannot treat them. They die because they cannot afford the treatment. According to Dr. Shetty, medicine has advanced tremendously over the last 50 years. Today's doctor can perform incredibly complex procedures using world-class technology. The tragedy is that these advances remain financially out of reach for a large section of society. This became the foundation on which Narayana Health was built. His belief is simple. Affordable healthcare is not a medical challenge. It is an operational challenge. So Narayana Health wasn't built to become another premium hospital chain. It was built around a much bigger question. Can world-class healthcare be delivered at a price that millions more people can afford while still creating value for shareholders? Most people assume lower prices automatically mean lower profits. Dr. Shetty disagrees. His argument is that instead of earning a high margin from small number of patients, hospital can earn attractive return by treating a much larger number of patients. More patients improve doctor productivity, increase utilization of expensive assets like operation theatre, MRI machine, then reduce the procurement cost and spread fixed expenses across a larger base. It is the same principle that transformed industries like aviation. Airlines don't become profitable by charging the highest ticket price. They become profitable by flying more passengers with greater efficiency. Dr. Shetty believes hospitals should work the same way. And that single philosophy explains almost everything investors admire about Narayana Health today. At this point, we understand what Dr. Devi Shetty is trying to achieve. He wants to make world-class healthcare affordable for millions of people. But philosophy alone does not build a successful business. Plenty of organizations have noble missions, yet very few manage to execute them while consistently creating value for shareholders. This is where Narayana Health becomes truly interesting because If you strip away the hospital building, the medical equipment, and even the doctors for a moment, what you are left really is an operating system. In my opinion, this operating system is Narayana Health's biggest competitive advantage. Most investors look for moats in obvious places: a strong brand, patented technology, or premium pricing. Narayana's moat is much harder to spot because it lies in how the business is run. Their flywheel is actually quite simple. Affordable healthcare attracts more patients. Higher patient volume improves the utilization of doctors, operating theaters, MRI machines, and other expensive assets. Better utilization lowers the cost of delivering healthcare. Lower costs allow Narayana to continue offering affordable treatment while still earning attractive return. And that in turn attracts even more patients. Then second pillar of Narayana Health is operational discipline. Narayana has spent years standardizing clinical protocols, digitizing workflows, and improving scheduling, all with one objective: to reduce the cost of delivering quality healthcare without compromising clinical outcomes. Technology in the business is not a marketing tool, it is an efficiency tool. Then its third pillar is hub and spoke network. Smaller hospitals and clinics handle the routine care, whereas complex cases are referred to larger flagship hospital. This ensures expensive infrastructure remains highly utilized while allowing patients to access care closer to home. Individually, none of these ideas are unique. Any hospital can buy the same MRI machine, hire experienced doctor, or implement new software. The challenge is replicating the entire system. And that's what I believe is Narayana's Health real moat. It is not trying to win because it charges more. It is trying to win because it has built an operating system that delivers high quality healthcare at a structurally lower cost. Now, a good operating model should eventually show up in the numbers, isn't it? So let's move to the financials and see whether the economics actually support this thesis. Before we dive into financials, let's quickly understand what Narayana Health looks like today. So, company now operates 55 healthcare facilities across India, the Cayman Islands, and United Kingdom, with nearly 6,000 operational beds. About 73% of its revenue come from owned hospital, while another 25% comes from operated hospital, where Narayana manages hospitals on behalf of other institutions. Cardiac sciences continue to be its largest specialty, contributing roughly around one-third of revenue. Although over the years, company has steadily diversified into oncology, renal sciences, neurosciences, and several other specialties. This diversification is important because it reduces the dependency on a single specialty while creating multiple growth engines for the business. Now let's look at the numbers. The first thing that stands out is the consistency of growth. Back in FY15, Narayana Health reported revenues of around 1300 crore. Fast forward to FY26 and revenues are close to 8,000 crore. That's nearly 6 times growth in just over a decade. More importantly, this has not come from one exceptional year. The company has consistently expanded its business by adding capacity, increasing patient volumes, and broadening its presence across specialty and geographies. Even more impressive is the margin expansion. In FY15, company's EBITDA margin stood at just around 9%. By FY25, it has increased to nearly 24%. That's a remarkable improvement, especially for a company whose entire philosophy is built around making healthcare more affordable. Although its margin did moderate to around 20% in FY26, but that's because in FY26, Narayana acquired Practice Plus Group in the UK, which currently operate at lower margin than the India business. On top of that, there were one-time acquisitions and integration cost. So this appeared to be more of a business mix issue than any deterioration in the core operating model. Company's operating profits have grown from just about 128 crore in FY15 to nearly 1600 crore today, an increase of more than 12 times. If you look at the PAT, the growth appears relatively muted over the last couple of years. However, that is largely because finance cost, depreciation, and tax expenses have all increased following the recent expansion and acquisition cycle. At the operating level, the business continued to perform well. Now, one area that has naturally attracted investors' attention is the balance sheet. Their borrowing have increased sharply from around 880 crore in FY23 to nearly 5,800 crore today. At first glance, that might look worrying, but again, context is important. The initial increase in debt was primarily to fund greenfield and brownfield expansion across India. The biggest jump came in FY26 after the acquisition of Practice Plus Group in the UK. So this is not the debt taken to support a struggling business. It's debt raised to fund expansion. The real question going forward is whether these investments generate returns comfortably above the company's cost of capital or not. If they do, this debt will ultimately create value for shareholder. If they don't, then it becomes a risk worth watching. Another area where Narayana continues to impress is cash flow generation. The company consistently converts more than 90% of its EBITDA into operating cash flow, which is exceptional for a capital-intensive hospital business. Strong cash generation gives management the flexibility to fund future expansion while maintaining financial discipline. Finally, let's talk about the return ratio. Historically, Narayana Health has consistently generated ROCE about 20%, reflecting the strength of its operating model. More recently, ROCE has moderated to around 15%. In my opinion, this decline should never be viewed in isolation. Over the last few years, the company has invested aggressively into new hospitals and has also completed its latest acquisition of UK business. These investments immediately increase the capital employed, while the earnings from these assets take time to ramp up. So at least for now, the lower ROCE appears to reflect an investment phase rather than any structural weakness in the underlying business. Overall, if I step back and look at the numbers, they broadly validate the investment thesis we have discussed so far. Over the last decade, Narayana Health has not just become a larger hospital chain. It has become a more profitable business with stronger cash flow and consistently better operating economics. Yes, the higher debt and lower ROCE are important variables to monitor over the next few years. But at this stage, they are more of an expansion strategy rather than deterioration in core business. So far, we have understood why Narayana Health exists, how it operates, and why its business economics have improved over the years. But none of that automatically makes it a great investment from today's price. The real question investors need to answer is, where does the next decade of growth come from? Because hospitals are fundamentally different from software companies. They don't suddenly double their revenues overnight. Every new hospital requires land, regulatory approval, construction, equipment, doctors, and several years before reaching optimal occupancy. Growth is therefore gradual, capital intensive, and highly dependent on execution. In my opinion, Narayana's future growth will largely depend on 4 key drivers. The first is capacity expansion. India still has one of the lowest hospital bed densities among major economies, while demand for quality healthcare continues to rise because of higher income, increasing insurance penetration, and an aging population. That gives the entire industry a long runway for growth. Narayana is well positioned to benefit from this trend. This slide outlines Narayana Health expansion roadmap till FY30. Company plan to increase its bed capacity from around 5,750 to over 7,600 beds, adding nearly 1,900 new beds across key locations like Bangalore, Kolkata, and Raipur. The expansion include a mix of greenfield hospital, brownfield expansions, and lease facilities, allowing the company to balance growth with capital efficiency. Most of the new capacity is expected to become operational between FY27 and FY29. Then its second growth driver is geographic expansion. Historically, Narayana has been strongest in Bangalore and Kolkata, which together still accounts for nearly half of its total bed capacity and over 60% of hospital operating revenue. However, over the past few years, management has been expanding into newer markets like Delhi NCR, Gurgaon, Mumbai, Ahmedabad, Raipur, and Jaipur to build a pan-India presence. Interestingly, many of these newer hospitals are positioned as premium metro facilities, allowing the company to treat more complex cases and improve its blended average revenue per occupied bed, that is ARPOB, and the margins. This diversification also reduces the dependence on its flagship cardiac-focused hospitals where pricing has structural limitation. Then third growth driver is international expansion. In 2018, Narayana completed the acquisition of Health City Cayman Island in the Caribbean Islands. That time, in 2018, Cayman Island was a slow-ramping, subscale bed with around 27% occupancy. Today, Cayman is now a mature, high-margin business with 40% plus EBITDA margin, generating roughly around 1,200 crore of revenue. It is now a template, the Cayman playbook, that management want to replicate in other geographies. Last year, October-November 25, Narayana completed a 100% cash acquisition of Practice Plus Group Hospitals, which is UK's roughly 5th largest private hospital group and 4th largest NHS service provider for approximately £188 million. However, management believes it is not exporting low-cost healthcare. It is exporting its operating system. Over the last 2 decades, Narayana has built expertise in improving doctor productivity, increasing asset utilization, and running hospitals more efficiently. If management can successfully replicate these capabilities in developed market, the long-term opportunity could be far larger than India alone. Of course, execution risk also remains high. And this is something you should monitor closely over the next few years. Then final growth driver is health insurance. Traditionally, hospitals and insurance companies have operated on opposite side of the table. Narayana is trying to change that by becoming part of the entire healthcare ecosystem. Affordable insurance can bring more patients into the healthcare system while also strengthening long-term relationship with them. Although this business is still at a very early stage, but it has the potential to become another important growth engine over the long term. So if I step back, Narayana's future is not dependent on one single initiative. It has multiple growth engines working simultaneously. Ultimately, I think the biggest question is whether management can execute this expansion while maintaining the same operating discipline and capital efficiency that made Narayana successful over the last 2 decades. Because growing is relatively easy. Growing profitably is much harder. And that's exactly what you should be watching over the next 5 to 10 years. So far, we've discussed everything that makes Narayana Health an attractive business. But no investment is complete without understanding what could go wrong. So the first and probably the biggest risk is execution risk. Narayana's operating model has been built over more than 2 decades. Replicating that model across multiple new hospitals, newer geographies, and international market won't be that easy. If new hospitals take longer than expected to reach optimal occupancy, then margins and return on capital could remain under pressure for several years. Then second risk is doctor availability. Hospitals don't run on building, they run on doctors. As Narayana expand, attracting and retaining experienced specialists will become increasingly important. If company struggles to build strong clinical team in new market, then scaling the business could become much more difficult. Then third risk is international expansion. The acquisition of Practice Plus Group is strategically important, but it is also a big experiment. Healthcare regulations, labor cost, and reimbursement model in the UK are very different from India. If management fails to improve the economics of this business, it could weigh on the group's overall profitability. Then fourth risk is capital allocation risk. Over the last 3 years, borrowings have increased significantly as the company entered into an aggressive expansion phase. If these investments generate attractive return, shareholder will benefit. But if management expand too aggressively or invest in projects that fail to achieve the desired occupancy, then return on capital could remain lower for much longer than expected. And fifth risk is competition. The private hospital industry has become increasingly competitive. Players like Apollo, Max, KIMS, Aster, Fortis, Medanta, they are all expanding rapidly. If competitors successfully replicate some of Narayana's operating practices while leveraging strong brands or premium pricing, companies' competitive advantage could gradually narrow. And finally, there is valuation risk. Over the last few years, hospital stocks have seen a massive valuation re-rating. For instance, before COVID, Narayana used to command price to book of below 8, but now it trades above pre-COVID level. Price to earning has also been re-rated in last few years. Although if you compare its valuation against other established hospital chain, Narayana valuations are still decent. But every hospital has different growth story and hence different valuation. Its stock has rallied significantly post-COVID, but there's an excellent consolidation in last 1 year. Overall, I don't think demand for healthcare is Narayana's biggest risk. India's healthcare opportunity is likely to remain strong for decades. The bigger question is whether management can continue scaling the business while preserving the operating discipline that has made Narayana so successful over the last 20 years. That's one thing I would keep tracking as a long-term investor. So coming back to the original question, is Narayana Health a great business? In my opinion, the answer is yes. Company has spent more than 2 decades building an operating system that is genuinely difficult to replicate. It is not competing by charging the highest prices or building the most luxurious hospital. Instead, it has focused on something much harder, improving productivity while making quality healthcare more affordable. And if management continues executing well, India alone offers a massive runway for growth. Add international expansion and new initiatives like insurance and the opportunity become even larger. Having said that, it is not a risk-free story. The recent increase in debt, integration of UK business, aggressive expansion, and moderation in return ratio are all things investors should keep a close eye on. Great businesses can still become poor investment if growth slows or if valuation runs too far ahead of fundamental. Overall, I think Narayana Health is one of those companies where the real competitive advantage is not visible on the balance sheet. It lies on the way business is designed. That's what makes it fascinating to study. Whether the stock is a buy at current valuation is ultimately a decision every investor will have to make based on their own return expectation and investment horizon. But irrespective of whether you invest in the company or not, I believe Narayana Health offers an important lesson. Sometimes the biggest businesses are not built by charging customer more. They are built by figuring out how to deliver the same product at a structurally lower cost. And that's exactly what Dr. Devi Shetty has been trying to prove over the last 2 decades. So that's it from my side. Now I would love to know what you think about Narayana Health and which is your most preferred hospital stock for investment. By the way, if you are confused, I have also covered an ETF that invests in basket of hospital companies. You can explore that video as well. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.